the last 14 trading days, the S&P 500 has dropped over 10%, putting it into correction territory. And we've got individual stocks that are down 20, 30, even 40%. So a lot of people have been asking me, Adam, how much lower can the market go? So in this video, let me share my thoughts. For those of you who are totally new to the markets and you have not started investing, you may be very excited right now because at last stocks look cheap again. I've got a chance to start building my portfolio. And for those of you who are already in the market, you may also be excited at lower prices, but you may also be a bit nervous. Like, what's happening? Why are the prices keep going down? Now, whatever the case, remember that in the long run, the market always goes up. And high quality companies that generate higher revenue, profits, and cash flow year after year, they always go up. But again, the market doesn't go up in a straight line. It goes up and down through wave patterns. So if you take a look again at the last 10 years, you can see that the S&P 500 gained 246.8%. That's an annualized return of 13.24% a year with dividends reinvested. So in other words, if you stayed invested in the last 10 years, your money is growing at least 13% compounded. If you invest in individual companies like Nvidia, Palantir, you get, again, double, triple those returns. But again, take a look. The market did not and never has gone up in one straight line. The market goes through all these up and down wave patterns. So take a look, right? You've got, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So the market will always go through all these wave patterns. So currently the market is going through another wave down. What's the big deal? It's a classic textbook garden variety wave down. And right now the S&P 500 is only down 10%. And some people are freaking, oh my God, we're gonna die. No, you're not gonna die, right? It's part of the entire process. So if you take a look at the last 10 years, you can see that on average, the market goes through a correction at least on average once a year. And for example, back in 2015, we had a correction and it was because of the slowing global growth that freaked the markets out. Then in 2016, again, we had another correction because of the Chinese economy slowing down and they were afraid how it would affect the US markets. And then in 2018, we had Trade War 1.0 when Trump was first in power. That was a 12% correction. And then what happened in late 2018, early 2019 was a 20% drop. Now, this was actually not defined as a bear market. Bear market is when the market drops more than 20%, closes below 20%. That's a bear market. So this kind of like touched 20%, and it went up. So this was a bigger correction, and this was due to what we call the Fed taper tantrum, where the Fed they stopped quantitative easing and they raised interest rates and the market freaked out, so the market went down 20%. And of course in 2020 we had a full-blown recession. That was a full-blown bear market caused by COVID-19, where global economies shut down, market dropped 35%. And then in 2022 we had the Fed hiking interest rates at the fastest rate in 40 years. We had the highest inflation in 40 years. That triggered another bear market. Market went up 27%. So you can see that for bear markets, the market can go down more than 20%. It can go down 27%, 35%. But in normal corrections, of which we're in right now, they usually drop roughly about 10 to 14% thereabouts, right? So you can see we had another correction back in late 2023. There was a 10.8% correction triggered by weakening economic data. And then in 2024, another correction because of bad, disappointing earnings by technology companies. The market dropped 9.7%. Now the trigger is Trade War 2.0, where the market is down again 10%. Now I've been increasingly reading on social media, some people freaking out and talking about, oh my God, Trump's going to create a recession with this trade war and I'm going to liquidate my entire 401k. I'm going to sell everything. I'm just going to run into a cave and hide. And is that a good idea? Well, historically, statistically, no. It's never been a good idea to panic sell because of geopolitical economic reasons and because the market is down. So if you take a look at this chart over here, for example, you can see that during this 10-year period from 2009 to 2019, the S&P went up 495%. Sounds great, but I can tell you that the majority of investors were not in the market to enjoy that close to 500% return. Why? Because there's always something to be worried about. There's always something to scare people out of the markets. And people scare very easily, all right? And I mean, take a look. Again, during that 10-year period, the price didn't go up in one straight line. It went through a lot of ups and downs. And there were many scary headlines. And that's why I keep telling my students, don't read news headlines. Okay? If you want to read it for entertainment, but never let it affect your investment decisions. Never let it affect your emotions. I mean, take a look at all this news during that time. We had Chrysler, GM filing for bankruptcy. We have got 663,000 jobs lost in March. We had the BP oil spill, the flash crash, the most powerful earthquake to hit. The S&P downgrades the US debt. We have got the fiscal cliff. We've got taper tantrum, which I talked about earlier on. The US government shutting down. Ebola virus, contagion fears. We had global stock sell-off. We have got Brexit. We had election futures collapsing. We have the trade war 1.0 over here. Yield curve inversion. US government shutting down again. S&P enters a bear market. Charlottesville, emergency Fed injection. You got all these scary stuff. And in the words of Peter Lynch, one of the greatest fund managers that ever lived, he said, your ultimate success or failure as an investor depends on your ability to ignore the worries of the world long enough to allow your investments to succeed. So the same thing is happening now. After the market goes on a wave up, it's got to go on a wave down. Now, if you're an investor and you're seeing that your portfolio, the value is dropping, it's totally normal. Don't freak out. Okay, there's nothing wrong with you. It's part of the process. So remember that when your portfolio goes through drawdowns, how you feel about it and how you react to it is what will affect your long-term profitability. All right. So here are a few tips I can give you. The tip number one is this: no matter how good you are as an investor, no matter how skillful you are, you can't avoid drawdowns completely. Your portfolio can't grow every day, every week, every month, every year. It can't go up in a straight line unless you are a total fraud that fakes your accounts, right? So that was Madoff, who never had a down day or down year, all right? So if you're a legitimate investor, your portfolio will go through ups and downs. So think about it. Even the greatest investors in the world, Warren Buffett, Charlie Munger, Peter Lynch, where they beat the S&P 500 many fold, they can't avoid drawdowns. Look at Peter Lynch. He got a 604% return on his Magellan fund over his 13 years as a fund manager, beating the S&P 500 3x, right? His annual return was 29%. Now, if you ask people, how many of you would like to be able to get a 29% return on your portfolio? Most people say, yeah, me, right? But are you willing to go through the journey, the turbulence to reach the destination? Most people are not willing to go through that. But going through that drawdown is the price you pay for getting huge returns in your portfolio. So take a look. You can see that during that process, his fund went down 56%, 27%, 42%, 32%. It is part of the process. So same thing for me. I think I'm not too bad an investor. I've beaten the market consistently. But again, my portfolio doesn't go up every single day, week, month, or every single year. I do have down years as well. So again, I've showed this many times. This is my personal portfolio over the last 6 years. And my portfolio grew 228% over the last 6 years, outperforming the S&P 500 that gained 146%. My compounded annual return is 21%, which is way above the S&P 500. But you can see in the process, same thing, my portfolio dropped 25% during the COVID pandemic. My portfolio dropped 30% during the 2022 bear market. So currently, my portfolio is going through a drawdown as well. So in full transparency, let me show you. So currently the market is down 10% from the high. The S&P is down over 5% year to date. And my portfolio is down as well. Let me just log into my account and I'll show you. So there we are. You can see that year to date, right? So my portfolio is down 2.57%, which is less than the market. That's because I don't just hold technology companies. I hold consumer defensive stocks. I hold healthcare stocks. I've got some China stocks. I've got some European stocks. So that kind of like buffers the volatility of my portfolio. So if you accept the fact that temporary market declines and corrections and temporary portfolio drawdowns are part of the investment journey, and you have no control over when it's going to happen, how long it's going to happen, then you stay relaxed, you stay calm. You don't get upset about it because you've got no control over it. Right? So that's the first point. The second point to remember is that the market price doesn't always reflect the actual value of the business that you own. Remember, when you buy shares, you're owning businesses. In the short term, the market is an auction-driven market. The price is driven by demand and supply. And 70% of buying and selling are not done by human beings. They're done by high-frequency algo robots. So in the short term, the market price is driven by news, emotions, and manipulation. And oftentimes it's totally different from what the business is actually worth. So if you take a high quality company like Amazon or Meta or Google, or for example, Salesforce, one of the companies that I own, for example, in the last 2 weeks, the market price has changed by 20%, 15-20%. But if you think about it logically, the actual business, is it worth 20% less? No, the business has the same revenue, the same profit, selling the same products and services. In fact, the business, the intrinsic value is the same value, right? It's just that temporarily the market price gets disjointed by the value with the value of the business. It becomes mispriced. So as a successful investor, when you ignore the short-term market price, which is like an illusion, is what people buy and sell, and you focus on how the business is doing, you don't feel like you lost anything. Because remember, if Mr. Market has a panic attack and Mr. Market is willing to sell his shares of Nvidia and Amazon at 15-20% lower than a week ago or 2 weeks ago, you haven't lost anything. Unless you are as crazy as Mr. Market and you press the sell button as well. If you don't press the sell button, then whatever price you see is irrelevant, right? Because you own the same business. And as long as you have the patience to hold on to that business, over time, the value of the business will keep going up. And before you know it, in a couple of weeks or months, the market price will again readjust when sentiment changes. And the next thing you know, it's going to be back to all-time highs again. You go, shit, I should have bought more, right? So whenever you got a correction, it's always an opportunity to add more shares of high quality companies that you own or that you want to own. Now, some of you may say, I got no more money, I can't buy. Okay, if you have got no more money and you have no more funds to buy anymore, then you know what? Ignore the market. Don't even look at it. Go watch Netflix. Go watch something for entertainment. And again, in a couple of weeks or months, you look at your portfolio, it'll probably be back to all-time highs, and you probably have forgotten that was even a correction in the first place. Third point I want to make is that I noticed some people will look back and regret, shit, I should have sold 2 weeks ago at a high, why didn't I sell, right? Never look back and ask yourself that question. Never have that regret. You know why? Because if you entertain this thought that, I should have sold, then in the future, every time the market drops a bit, you will sell in panic. Every time someone predicts, there could be a recession, you're going to sell. And if you're so quick to sell in the future, you will never stay invested long enough to allow your investments to compound and grow in value. So never entertain that thought, all right? So question is, am I buying during this correction? Yes, I've been buying, all right? So those of you in my community, you know that I'm buying almost every day, all right? Now, I'm nibbling. As we know, during a correction, you can't predict exactly where's the exact bottom. You don't know exactly how long it's going to last. So you never go all in at one time. So to me, as long as a great company that I want to buy more of is undervalued and it retraced to a support level, I would slowly add. I would slowly add in many tranches. Now, will this ongoing trade war really affect the underlying businesses? Could their profits really be affected? The answer is yes. Certain kind of businesses. So especially businesses in the industrial and manufacturing industry, agricultural businesses, automotive businesses, retailers, they could really be affected by these tariffs because it would increase their imported goods, and if they can't pass it on to the consumer, that would reduce their profit margins and their share price could drop because there's an actual drop in profits. Those are the companies, yeah? So for me personally, as you know, I don't like to invest in companies in those industries. I don't like industrial, manufacturing, automotive, agricultural, energy companies. I avoid those companies because they tend to be very cyclical. They tend to be in very competitive industries. So personally, I like to buy companies that are less prone to the effects of a recession or are in fact pretty recession proof. And I like to buy companies in industries that are not affected by tariffs. All right. So what are some examples of companies I've been adding? So I just added more of S&P Global, which I already own in my portfolio for many, many years. I've been holding for many, many years. And every time the price drops below the intrinsic value, I'm adding more because S&P Global is a company that again is recession proof. Well, I wouldn't say it's 100% recession proof, but it is less prone to recession. It's not affected by tariffs. It's got a very strong economic moat. It's got very consistent and predictable revenue, profits, and free cash flow. All right, so this is S&P Global. And I just added more, in fact, yesterday. Or was it the day before? Sometimes I forget, right? But I just added more, right? So you can see the intrinsic value is $495. And the moment it drops below the intrinsic value to my support level, I'm adding more. Now, did I go all in? No, because again, for every stock, I've got at least 3 to 4 support levels because you never know, it could correct to the next support level. So whenever it drops to another support level, that's how I do dollar cost averaging. I will add more as it drops to lower support levels. But will it go to the next support level? Again, I can't predict. That's why I buy one tranche first. And another stock that I just added, which again I think is pretty less prone to recessions, that I think has got a very strong moat, that I think is not affected by tariffs, is CrowdStrike. And I already own Fortinet and I own Palo Alto, which are the two giants of the cybersecurity world. CrowdStrike is a smaller company. The moat is not as strong as Fortinet and Palo Alto, but they are growing their moat. And it's more of a speculative company at this stage, so I don't buy too much of it, but I found it an opportunity that now it has dropped below the intrinsic value of 345 and it hit the second support level at 303. All right, that's the first support, second support. So I bought it somewhere in between the first and second support level. So again, there are many bargains out there, but important thing is, select companies that meet your investment criteria. These are the high quality companies. Now, of course, needless to say, the usual suspects like Nvidia, like Meta, like Amazon, like Google and Microsoft are looking pretty attractive as well. Again, to me, this is not an advice or recommendation that you buy. You got to do your own research before you can see what fits your investment criteria. So let's get back to that first question, which is the market has dropped 10% from the highs. How much lower can it go? Well, again, we can't predict for certain, but we can make some educated guesses. So my guess is that I think the market will drop at the very most another 2 to 3%. That's it. Okay. Now, why? So again, if you take a look at history, if it is not a bear market, remember, bear market usually coincides with recession. So if it's not a recession, if it is not a bear market, a usual correction would normally be between 10% drop to 14% drop. So since we're already down 10%, then like I said, I'm only looking at another 2 to 3%. And I'll show you the charts in a short while. Now, some of you may say, but how do you know it's not going to be a recession? Now, of course, it could be. I can't predict for certain, but at this stage, I don't think a recession is on the cards. At least not for now. And there are a few reasons why I don't think it's going to be a bear market. So first of all, let's take a look at the Fed economic data, and you can see what's the probability of a recession. Well, it has gone up from 5% probability to currently is gone up to 28% probability. 26% chance of a recession. It's still a low probability from now. Now, for some people who are saying, but the GDP growth estimate by the Atlanta Fed is showing a contraction of 2.4% GDP for Q1. Isn't that concerning? Well, the Atlanta Fed, they just clarify the reason for this negative figure for Q1 GDP estimate is because of a big decrease in net exports. Now, remember that when the US exports, it is positive GDP. When they import, it is negative GDP. So there was a surge in imports. Now, all the big surge in imports came from non-monetary gold. As you can see, there was an increase in non-monetary gold imports from 13.2 billion in December last year to 32.6 billion in January. So because of this surge in imports, in non-monetary gold imports, that caused the net exports here, change in net exports to decline from a usual minus 29 to minus 256. So this caused the negative GDP reading. Now, if you actually take away that distortion because of the gold imports, then GDP is actually not negative. It's not as bad as what people make it out to be. Now, the other interesting thing is that if this market decline is caused by the trade war, then the trade war partners should also see a drop in the stock market, but they're not. You can see that China, which is one of the US trading partners, the China stock market is up 21% year to date. And Mexico, that is also in this trade war, the stock market is up 3.5% year to date. The only one that's down is Canada, right? Canada is down 2.61%, but again, it's only down 2%. So this tells you that a lot of the sell-off may actually be an excuse to push the market down. It's a lot of manipulation and not actually because of the trade war or the recession. So that's something to think about. The other thing is this: if the market truly believes that there's a recession coming, what do you think is going to happen? A lot of investors will dump stocks and buy treasury bonds, because treasury bonds are a safe haven when there are recession fears, and that will cause the TLT ETF to fly up and the 10-year treasury yield to collapse. But it hasn't. If you look at a 10-year treasury yield, it has come down from 4.8% down to 4.1%, but in the last week, the 10-year yield has not kept going down. It's actually been going up. So this tells you that the bond market doesn't believe that there is a coming recession, at least not for now. Once again, if there's no recession, it is not a bear market, it's a usual correction, then highly likely we will drop to, at the very most, 5,358 on the S&P 500. So this is where I think is the lowest the market will go. So currently the market is here. Again, the market is down 10% from the high. And I think at the very most, we drop another 3 to 4% to this level, where the total decline from the high would be at the most about 13%. So again, that's just my guess. Now, some of you may ask, how did I draw all these support levels? Well, if you take a look at the long-term trend of the S&P 500, let me just zoom out. These are the monthly candles on the very long-term trend. You can see, first of all, during a bear market crash, the S&P finds support at the 50 moving average on the monthly candle. So this is during a big crash, usually a bear market, right? So that's why 4637 at the blue line, that is where it will go to if it's a recession bear market, which I don't think it is. Okay, so we're not looking at this number over here. So if it's a usual correction, you can see that the market tends to drop to this red line, right? Drop to this red line during a usual correction. This red line is the 20 EMA on the monthly candles, and that's why I added this line here, 5358, and another support at 4876 that coincides with the 40 EMA, this blue line over there. So we're looking at this level over here. So if I zoom back to the weekly candles, you can see where we are right now. Now, if you put in a Fibonacci retracement tool, you can see if you take that as the A to B wave, this 5358 coincides with the 38.2% Fibonacci level as well. All right. So again, this is just my guess. There's no way to predict for certain, but again, my guess is that we are going to bottom anywhere from now to this level over there. Okay, so in the meantime, as we're going through the correction, I will be slowly continuing to add shares of my favorite companies. I hope this has been useful. Thank you for listening, and as always, may the markets be with you. Stay safe and stay profitable. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.